Annuities and reverse mortgages, the good, the bad, and the ugly.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Annuities and reverse mortgages don't go together. Now, if you're a seasoned reverse mortgage professional, that concept has been chiseled into your mind for decades, like the 10 Commandments that Moses carried down from Mount Sinai. After all, we've been warned against what regulators call cross-selling, the unforgivable sin. And that's where a commission-motivated insurance agent who also originates invests a reverse mortgage borrower's loan proceeds into an annuity contract. That practice is strictly verboten. In fact, it's directly spelled out in the 2008 HERA, Housing and Economic Recovery Act legislation, that prohibits a lender from requiring a borrower to purchase an annuity contract as a condition of obtaining a reverse mortgage loan. Jack Guttentag, also known as a mortgage professor, we've covered his stories in this show before, well, he turns the conventional wisdom of annuities and reverse mortgages together on its head in his recent column entitled, Why Annuities Are Underutilized and What Could Be Done About It. He argues that annuities should be part of most retirees' financial plans, yet those who stand to benefit the most are rarely using them. Now, for those of you who are unfamiliar with an annuity, they're basically a contract between a policyholder and an insurance company. And generally, there are two types. A deferred annuity, that's where interest earnings or credits are compounded on the principal over time and the money's locked up. And then a single premium immediate annuity, and that pays the policyholder a series of regular payments or installments for a specified period of time or life. If an immediate annuity sounds a lot like a home equity conversion mortgage's 10-year payments, you're not mistaken, as 10-year payments are annuitized. That is, they're paid out based on the borrower's age and life expectancy. The older you are, the higher payout you're going to see in a HECM 10-year payment plan or an immediate annuity for that matter. Guttentag promotes what I would call a split annuity concept. Instead of the borrower simply converting their entire loan proceeds into a HECM 10-year payment plan, a portion of the HECM's line of credit, or the principal limit, would actually be used to purchase a deferred annuity. And then the rest would be left in a line of credit where the borrower can take regular distributions, and that would help meet their monthly cash flow needs while that deferred annuity continues to grow in value. Now this, Guttentag argues, provides significantly more funds over a fixed 10-year payment plan alone. This example shows the projected payout of a 10-year only plan compared to a combination of a 10-year payment and annuity based on the best and worst quotes that Guttentag received from competing lenders. And while the specifics of his hybrid payout structure are not spelled out, they do appear to be strikingly similar to a strategy that insurance agents call an annuity ladder. And one example of that ladder entails taking a portion of funds to purchase a 5-year annuity, a deferred annuity, and it locks up the premium paid during that time while it's earning a more competitive interest rate. Then you take the remaining chunk of money to fund an immediate annuity, and that pays out for a period certain term of 5 years. At the end of the 5-year payout from the immediate annuity, that deferred annuity would be matured and annuitized into a monthly lifetime payment, and it's being boosted by the accrued interest earned and the policyholder's age, providing a higher monthly payout. Now, the options and varieties of annuity ladder plans are too numerous to discuss today, but suffice it to say they all have the goal of increasing interest earnings that outpace inflation while they boost the monthly payout. Now, any purchase of an annuity is in essence, especially with a reverse mortgage, putting more risk on the shoulders of FHA as the borrower is taking a partial lump sum. And one could argue, since the funds are separated, the borrower does stand to benefit, no longer having the risk of discontinued payments should they violate the terms of the loan or cease to occupy the property. However, there are significant challenges that do remain, such as HUD's opposition to using HECM funds to purchase an annuity, the acceleration of the HECM's loan balance due to large distributions of loan proceeds, and insurance companies that are not accepting premium payments that do come from home equity. It's right on their applications. In conclusion, while industry professionals continue to steer clear from the complications and the legal risk that annuities entail, Guttentag maintains that there are, in fact, tangible benefits to an ethical, regulated, and well thought out plan that incorporates an annuity into the structuring of a reverse mortgage loan. If there is one takeaway we can apply today, it is this: how a reverse mortgage is structured is just as important as the proceeds of the loan itself. Now, what are your thoughts? You can leave your comments in the comment section below. A very complex subject, by the way. And please share this video with other professionals. I think it's a topic that warrants discussion, you can do that using the social media links on this page. And if you'd like to subscribe to our YouTube channel, you can do that by clicking on the subscribe button right above this video frame. Have a great week. Don't forget, our podcast just came out today. You can find that also at HECM World or on iTunes. We'll see you next week.